The nature of the derivative product lends itself to creating structures with a variety of payoff profiles, which can be designed to reflect a particular hedging requirement or market view. This has given rise to a wide range of derivative products, which are labeled as exotic or second and third generation derivatives. By their very nature, such instruments will often be created as one-off structures to fit the needs of a particular group of users or a set of market circumstances which may never work again. Some of these products are now almost becoming mainstream instruments in the major currencies, and accordingly might no longer be regarded as exotic. Without doubt, exotics are used to create efficiencies in the premium costs or to enhance yield. While some of the exotics are intended as more precise hedges than plain vanilla derivatives can offer, many more have been created to give a leveraged payoff to reflect a speculative view. Whether they create or mitigate risk is a function of their application, and it is for both the supplier and user to ensure that the instrument is both understood and appropriate before committing to a deal. Because of their complexity and heterogeneous nature, exotic options are often traded over the counter rather than through an exchange. The main distinction between European options, whose payoff is linearly linked to the path of the underlying, and binary or digital options is that their payoff is discontinuous and therefore does not depend on the relationship between the underlying and the strike price. It simply depends on whether or not the option has finished in the money. In other words, the binary payoff is a predetermined fixed amount that is payable if the underlying reference asset trades above, in case of a call, or below, in case of a put, at either expiry, European style, or at any time throughout the life of the option, American style or one touch. Binary options can be used on almost any underlying, but are best suited to markets where support and resistance levels are found, for example the currency, equity, and fixed income markets. If an investor believes that a currency will not fall below a certain level, the investor could write a binary option to earn premium. The advantage being that the investor would be able to determine the maximum losses should the market move in the opposite direction to the expected view. Binary options can be traded as either cash or nothing or asset or nothing options. A simple example of a cash or nothing call pays off nothing if the asset price ends up below the strike price at maturity, and pays a fixed amount P if it ends up at or above the strike price. In other words, assuming a risk-neutral environment, the probability of the asset being at or above the strike price at maturity of the option is equal to N of D2, as derived from the Black-Scholes formula. It follows that since binary options are inherently a bet on a future event occurring, its value is equal to the present value of the product of the predetermined payoff and the probability that the option is exercised, i.e. finishes in the money. It also follows that the premium will increase as the predetermined payoff increases. Binary options are useful tools which enable investors and liability managers to monetize their views on the market direction. For example, an asset manager believes that 3 months LIBOR is likely to rise over a given period of time, but is unsure of how much the rate will rise. A plain vanilla call option may prove to be insufficient if the manager gets the strike price wrong and the magnitude of the subsequent rise over and above the strike price. Binary options are frequently used to take views on spread relationships. To illustrate this, suppose that the difference between the current 10-year and 2-year US swap rates is 100 basis points, and the investor believes that based on current market conditions, this difference in yields will widen further over a 6-month period, but is unsure as to the extent of further widening. To monetize this view, the investor could buy a binary spread option, which will pay a predefined sum of money if the view is right and nothing if wrong. The notion of speculating on a yield curve spread can easily be extended to entertain the possibility of betting on the yield curve differential across different environments. Binary options can be combined with plain vanilla options to create contingent premium or pay later option structures, where the option premium is only payable if the structure finishes at or in the money. In short, a structure in which you only pay the option premium when you need it. For example, a corporate treasurer enters into the following two trades. The treasurer buys a vanilla call option on US dollars against yen with a strike of 120 and a premium of $150,000. The treasurer sells a binary US dollar call against yen with the same strike and a predefined payout equal to the premium value of the vanilla call option. The premiums payable in both trades cancel each other out, leaving the treasurer with a short binary option position which is only payable if the spot at maturity, a European-style option, is greater than 120. If the binary payment is triggered, the treasurer then is delivered the vanilla option. If, however, the vanilla call option is out of the money at expiry, the short binary call option will also be out of the money and will not be exercised. Therefore, the contingent option holder does not have to pay out any premium. The premium a customer will pay for a contingent premium option will be much larger than for a comparable vanilla option where the premium is paid up front. While binary options may be relatively easy to price, the hedging is not quite so straightforward. Binary options exhibit explosive deltas and gammas as they approach expiry and/or the strike, rendering them difficult to hedge. It is common practice to hedge a short binary option with a static hedge by buying call options at a lower strike and selling the same amount of call options at a higher strike, in effect hedging with a call spread. Since the binary payoff is discontinuous, any static hedge does not perfectly replicate the exposure and will need frequent rebalancing over the life of the option, over and above the leverage required initially to match the required binary payment. Moreover, the need to trade the spread in large size makes this replication strategy impractical. Now let's look at barrier options. Barrier options are path-dependent options and are like plain vanilla options but with one exception: the presence of one or more triggers that, if touched at any time before maturity, causes an option with predetermined characteristics to come into existence, in the case of a knock-in option, or cause an existing option to cease to exist, in the case of a knockout or a kick-out option. In either case, the underlying option is either a vanilla call or put. Knock-in barrier options allow the buyer to pay a premium upfront and receive an option that will not start until the price of the underlying reaches a barrier. The barrier may be greater or less than the exercise price, and once the barrier is breached, the option behaves as an ordinary European call or put option with an identical payoff formula. Knockout barrier options allow the buyer to again pay a premium upfront and receive a call or a put option that is forfeited should the underlying break through the predetermined barrier level. It is important to note that since a knock-in option is one that only exists if the underlying price reaches a set level, if the barrier is placed between the current underlying price and the strike, then the option will knock in before it is in the money and so is identical to a standard option. Similarly, for knockout options, the barrier should normally be placed below the strike, otherwise it will knock out before it has a chance of being exercised. A knockout option in which the barrier is in the money with respect to the strike is called a reverse knockout or kickout option. A knock-in option in which the barrier is in the money with respect to the strike is called a reverse knock-in or kick-in option. Barrier options can be further defined by the type of barrier condition. Inside barrier options, where the barrier relates to the asset underlying the option. Outside barrier options, where the barrier relates to an asset other than the one underlying the option, described in more detail below. Note also that owning a reverse knockout option and a reverse knock-in option with the same maturity, strike, and trigger is equivalent to owning the corresponding standard option. Intuitively, barrier options should be cheaper than their plain vanilla options because they risk either not being knocked in or being knocked out. A double knockout option is cheaper than a single knockout option because the double knockout has two trigger prices, either of which could knock the option out of existence. How much cheaper a barrier option is compared to the vanilla option depends on the location of the triggers. It should also be noted that the higher the implied volatility at the time the option is priced, the cheaper the knockout option with the in-the-money barrier will be compared to the similar plain vanilla option. Higher implied volatility suggests a greater probability of triggering the barrier and knocking out the option. The reverse is true of the reverse knock-in option. It will still be cheaper than the plain vanilla option, but not by very much. The higher the implied volatility, the less of a difference there will be in price between the reverse knock-in option and the comparable plain vanilla option. One major attraction of the barrier option is that there is no need to pay for all price probabilities that are unexpected. Hence, trigger levels are typically placed near technical trading levels such as support and resistance. Like binary options, barriers offer highly leveraged delta exposures for less premium, but they are also difficult to risk manage and need constant monitoring. Down and out barrier calls or up and in barrier calls are useful as speculative strategies on underlying assets. Up and out calls or down and in puts are similarly useful if the underlying asset price is expected to fall. Having decided which barrier option to use, the position of the barrier must then be decided. The closer the barrier is to the exercise price, the more expensive a knock-in option will be and the cheaper a knockout option will be. Knockout options are often preferred, since many users wish to rid themselves of the option when it's no longer needed. An example of such an application is frequently used in American conditional forward currency transactions that are used in mergers and acquisitions. So who are the major users of barrier options? Speculators who believe in trends and correlation in a market, placing the barrier levels around critical technical support and resistance levels. Corporations looking for cheaper option premium and for those that have contingent exposures that need to be matched should an asset event occur. Structured product buyers who are using such products to cheapen access to the optionality and/or looking for yield enhancement and leverage within the structure. Asian or average rate options are another path-dependent structure where the payoff characteristics depend on the average value of the underlying over the life of the option or at least some part of the option's life. The attraction as a hedging or investment tool relies in part on the lower volatility associated with the averaging process and hence the lower cost relative to plain vanilla options, since the payoff is not dependent on a single final value of the underlying at maturity. To put it another way, the relative cost advantage derives from the fact that an average rate of a number of fixes over a period of time will have a lower volatility than each fixing individually. Since volatility is the key determinant of an option price, ergo the Asian option must be cheaper. The Asian option can therefore be viewed as an option on a portfolio of underlying assets. There are two main types of Asian options available: average rate or average price options, AROs or APOs, where the payoff at expiration is the difference between the average of the prices recorded over a specified period of time and a predefined strike price. Or average strike options, ASOs, where the payoff at expiration is the difference between the value of the underlying on the expiry date and the average of the prices recorded during the calculation of the strike price. As there are two kinds of Asian options, there are two kinds of average calculation, the arithmetic and geometric. The arithmetic average, obtained simply by dividing the sum of two or more items by the number of observations, is most often used in daily life or where averages are concerned. The payoff depends on the sum of the underlying asset prices, since the average is determined by the arithmetic mean of the underlying price at specified intervals. The geometric average is the nth root of the product of the n sample points. Although geometric Asian options are not commonly used in practice, they are often used as a good initial guess for the price of arithmetic Asian options. This technique is used to improve the convergence rate of the Monte Carlo model when pricing arithmetic Asian options. The possibility of achieving an average value rather than relying on an extreme value is of particular relevance to the corporate and retail investor markets. Corporate exposures are frequently measured with regard to an average rate over budget periods, or the FX translation exposures over and or between accounting periods reflected on the balance sheets are increasingly being monitored on a periodic average basis. Similarly, the retail investor market is attracted by both the possibility of minimizing the exposure to an extreme value at expiration, offering a quasi-crash protection buffer, and the opportunity of cheaper access to the markets. As a retail product, they are found in many structured notes offerings. Due to their relative cheapness, they can offer higher leverage or participation rates that make the notes look cosmetically more attractive. Aside from the path-dependent characteristics, options are less susceptible to possible spot manipulation at settlement, which has become one of the growing arguments against the use of binary or barrier options. Rainbow options derive their name from the fact that their underlying is two or more assets rather than one. Rainbow options are exposed to two or more sources of uncertainty, as opposed to a plain vanilla option that is exposed to one source of uncertainty, such as the price of underlying asset. Rainbow options are structured typically as calls or puts on the best or worst performer of an underlying basket of assets. Once you have determined the best worst performing option, the option is then only exercised if this option is in the money. This is determined by comparing the option's actual movement to the strike as follows. For a best of call, percentage move of the best performing option greater than the strike. For a best of put, percentage move of the best performing option less than the strike. For a worst of call, percentage move of the worst performing option greater than the strike, i.e. if the worst performing option increases by more than the strike. And for a worst of put, the percentage move of the worst performing option less than the strike. Mountain range options are essentially a combination of basket options and range options, two types of exotic derivatives which have particular characteristics which make them useful hedging tools. The two most popular structures are the Altiplano and Himalayan. Altiplano options entitle the option holder to a large coupon if no stock in a given stock selection reaches a predetermined limit or barrier during a given time period. Otherwise, the option holder receives a payoff of a plain vanilla option or sometimes zero return for the observed period. Himalayan options are similar to Asian options. The Himalayan is essentially a call on the average performance of the best stocks within the basket. Throughout the life of the option, there are particularly measurement dates where the best performer within the basket is removed, and this process is continued until all the assets with the exception of one have been removed from the basket. The total return on this last stock is taken as a final measure. The payoff is the sum of all the measured returns over the life of the option. These options are often considered a correlation trade, since the value of the option is sensitive to the correlation between the various basket components. The crucial issue when dealing with mountain range options is that the pricing is primarily dependent on the correlation between the constituent stocks. As the number of stocks in the basket increases, the dimension of the pricing equation increases to a point where accurate pricing of the option becomes a concern, particularly in larger baskets. But why are they used? For cost efficiency. Multi-asset products are cheaper than the corresponding sum of the individual options. The effect of correlation makes the product competitive. Also for risk diversification, particularly relevant if the basket is composed of multi-asset class constituents. Improved hedge dynamics for portfolio exposure. Correlation products provide better hedges for portfolios of investors and traders that have exposure to a large number of constituents or for corporates that have risks to various market instruments. Hedge against correlation. Correlation products enable traders to lock in the current implied asset correlation and thus providing a more suitable delta hedging for portfolio exposures.